The RBA pause has been extended for another month, leaving a growing chorus of opinions that we've reached the peak for interest rates. Our thoughts and forecasts in these fluid and volatile market conditions. The latest reprieve from further RBA rate hikes was well anticipated after the better-than-expected quarterly CPI numbers and the fall in retail sales in June, showing that the 4% of rate hikes delivered so far is impacting spending and helping to dampen inflation. While other central banks have kept hiking rates in the last few weeks, including the US, Canada and the Bank of England, leaving a widening gap between our 4.1% cash rate and the rest of the pack, the market expectation now is divided between one and no more RBA rate hikes. Our expectation, however, is still for one more increase, potentially in November, after the next quarterly inflation numbers, dependent on their further progress. With greater confidence, we continue to suggest that rate cuts are unlikely until 2025 and will be predicated on core inflation returning back below 3%. The second quarter inflation numbers were encouraging, with the consumer price index down to 6% and only 0.8% for the quarter, so clearly headed back towards 3%. Core inflation also fell to 5.9%, but the challenge for new RBA Governor Michelle Bullock will be how long it will take to get back to target, especially with services inflation heading in the wrong direction as opposed to goods inflation, a trend being seen in similar economies overseas. We still expect to see slow real economic growth in this new financial year and a steady increase in the unemployment rate due to higher interest rates. However, the latest jobs data was again remarkably strong, showing the resilience of our economy. Unemployment fell to just below 3.5% in June and has yet to be impacted by the recent surge in net migration and population growth, another sign of the longer lag in this tightening cycle compared to more normal economic conditions. But this adds another complication to RBA policy settings with its implications for services inflation. Having record levels of employment is a helpful factor as the economy slows, but we still need a lift in labour productivity to make real wages growth sustainable. And lastly, the Aussie dollar once again failed to break the 69-cent barrier in July, so is now testing the lower end of the recent 64.5 to 69-cent band. Further policy announcements out of China will be very relevant on this front, given their implications for our export markets. And that's the market update from Bendigo Bank.